Ever feel like those investing guidelines they throw around are more like loose suggestions?
I know what you mean.
We're about to take a deep dive into one of those. Invest in a growing economy.
Yeah,
It's catchy, right?
sure.
But does it actually hold up?
So we're here to find out. Our main source today is a 2005 paper by finance professor J.R. Ritter,
Okay.
aptly titled Economic Growth and Equity Returns.
Straight to the point. So this paper, it was published in the Pacific Basin Finance Journal.
That's right.
And Ritter, he dove into over a century of data
He did.
from multiple countries. A
Yeah.
century of data. What did he find?
Well, get ready for this, because he found that there's actually a weak connection
Really?
and potentially even a negative correlation between a booming economy and how well stocks perform.
Okay, now that has me intrigued. Most people think strong economy, companies do well, stock prices go up.
Right.
Seems pretty straightforward.
You think so?
Yeah.
But the market doesn't always follow a straight path. See, a growing economy doesn't automatically mean bigger profits for publicly traded companies. And at the end of the day, it's those profits that really dictate stock prices.
So a country could be experiencing rapid growth, but if that growth isn't translating into higher profits for the companies investors are buying into,
Yeah,
their stock returns might not reflect that economic boom.
exactly. It's not a direct correlation like a lot of people assume.
Mm-hmm.
To illustrate this, Ritter found a negative correlation between real stock returns and real per capita GDP growth,
Interesting.
and not just in a small sample size. This is across 16 major economies from 1900 to 2002.
Wow, that's a significant time frame.
Yeah.
Are there any specific examples that really highlight this disconnect?
Absolutely. Ritter's data shows that, surprisingly, Australia and South Africa outperformed the U.S. in terms of stock returns during that period,
Huh.
even though their economic growth was much lower than the U.S. during that same time frame.
That's fascinating. And I guess it makes this whole conversation much more than just an academic exercise.
Oh, for sure.
For anyone who's interested in investing, this is
Yeah, this is real-world stuff.
applicable.
Absolutely. It's not just about understanding history. It's about challenging our assumptions of what drives market returns. And here's the thing. The trend isn't limited to the early 20th century. When looking at data from 1970 to 2002,
Okay.
the negative correlation persists.
So we're seeing this pattern across different time periods. What's the explanation? Why wouldn't a booming economy mean automatic success for investors?
The key here is understanding that not all economic growth, it's not created equal.
Okay.
Two economists, Krugman and Young,
Right.
they argued that a large portion of economic growth can come from just adding more labor and capital.
Okay.
Picture a country that's rapidly industrializing, more people working, factories being built.
Yeah.
All of that boosting GDP.
Right. So even if the overall economic pie is getting bigger, that doesn't mean the slices going to existing companies are getting larger.
Exactly. Think of it like this. Imagine a company that makes clothing,
Okay.
publicly traded. Investors are buying their stock. Now, the country's economy grows because there's, say, this huge wave of new construction workers.
Right.
Great for overall GDP, but does it directly translate into higher profits for that clothing company?
Probably not.
Not necessarily.
That makes sense. So what does move the needle for existing companies and their stock prices if it's not just general economic growth?
That's where the type of growth comes into play. Let's switch gears from increased labor and capital
Okay.
to the impact of technological progress. This is where things get even more interesting.
I love when things get interesting. Lay it on me.
Both Warren Buffett and Jeremy Siegel,
Okay.
they've argued that in a competitive market, innovation often benefits consumers more than company owners.
Hold on. So new technology, better products, that's not always good news for shareholders.
Sometimes not.
That seems counterintuitive.
It can be, right? Think about it. Innovation often leads to lower prices for consumers,
Right.
forces companies to constantly upgrade their products,
Sure.
which is great for us shoppers. But if companies are constantly having to lower prices, constantly having to make new products
Yeah.
to keep up with competition, it can shrink their profit margins.
So even if a company is growing, keeping pace with all the latest advancements, it might not actually be showing up in the profits that investors care about.
Precisely. That's exactly right. And there's one more piece to consider when we're talking about economic growth and stock returns, and that is reinvestment.
Okay.
If a lot of that growth is fueled by brand new companies popping up, or a surge of investment is going into private businesses,
Yeah.
that doesn't necessarily benefit those who are holding stock in existing public companies.
Okay, so we've established that simply chasing a growing economy isn't some foolproof investing strategy.
Right.
What should we be paying attention to then?
Well, Ritter argues for a critical shift in focus.
Okay.
He says we should be less concerned with past returns, even predictions about future economic growth,
Okay.
and instead pay much closer attention to a company's earnings yield.
All right, let's break that down. Earnings yield, that's the company's earnings per share divided by the share price.
You've got it.
Okay.
It's essentially a measure of how much profit you're getting back for each dollar you have invested in a company.
So it's about what I'm actually getting back as an investor, not just some abstract idea of growth.
Exactly. And here's the logic. Those earnings, they can be paid out to shareholders through dividends
Right.
or share buybacks. Or they can be reinvested by the company to, hopefully grow even more.
Right.
Ritter argues that over the long term, your returns as an investor, they should roughly equal that earnings yield. If those earnings are reinvested wisely, of course.
That makes a lot of sense. So as an investor, a higher earnings yield is generally a good sign.
In theory, yes. But as with most things in finance, there are always caveats.
Of course.
For one, companies can manipulate their earnings.
Oh, sure.
They might try to smooth them out, to make their business cycles look less volatile.
Right. So it's not as simple as just looking at one number in isolation. We need to understand the context.
Exactly. You got it. And that's where corporate governance comes into play, which is another essential factor Ritter highlights.
Okay, so let's talk about corporate governance. What does that mean, and why is it so important when we're evaluating potential investments? Okay, so let's talk about corporate governance. What does that mean, and why is it so important when we're evaluating potential investments?
It's a good question. In simple terms, corporate governance, it refers to how a company is run, how decisions are made, and how the interests of shareholders are protected.
Got it.
It's about transparency, accountability,
Right.
making sure that those at the top, they're acting in the best interests of all stakeholders.
So even if a company looks good on paper, maybe with a solid earnings yield, bad corporate governance, that could be a deal breaker.
Oh, absolutely. Imagine a company with great earnings, but the management, they're engaging in shady dealings,
Yeah.
making poor investments with shareholder money. Or maybe they're just prioritizing their own enrichment over the long-term health of the company.
Right.
That's a recipe for disaster, even if their current earnings look fantastic.
That makes perfect sense. So it's not just about the numbers, it's about understanding the people and practices behind those numbers.
Exactly. Investors need to look beyond just the financials. They need to try to gauge the integrity, the competence of the management team. Are they transparent with shareholders? Do they have a good track record?
Right.
These are crucial questions to ask.
Yeah, it's like that old saying, past performance is not indicative of future results.
Right.
But maybe it's more like past performance without good corporate governance, that's a red flag.
Yeah, I like that. It's about looking at the whole picture. You wouldn't invest in a company without understanding its financials.
Right.
You shouldn't invest without understanding its governance either.
Okay, so we've debunked this myth. A booming economy equals instant stock market success.
Right.
We've talked about why earnings yield is this key metric.
Yeah.
And how corporate governance can make or break an investment. But for our listeners out there who are thinking, this is a lot to digest, what's the main takeaway for my portfolio? How do we put this all together?
It boils down to this. Be an informed and discerning investor.
Okay.
Don't just get swept up by headlines about, roaring economies.
Right, right.
Understand the source of that growth. Is it sustainable? How is it actually benefiting the companies you're invested in?
So look beyond the hype and dig a little deeper.
Precisely. Look at those earnings yields. Scrutinize dividend policies. And absolutely factor in the quality of corporate governance.
Yeah.
When you're evaluating an investment, it's about understanding the nuances, not just reacting to the surface-level trends.
That's great advice. Now, before we wrap up, I wanted to circle back to something that Ritter mentioned that I found really intriguing. He pointed out that investors often assign these higher price-to-earnings ratios to companies in high-growth economies. Even though, based on everything we've discussed, a high PE ratio, that could actually signal lower potential returns over time.
Right. It does seem counterintuitive.
Right.
But it gets to the heart of market psychology.
Yeah.
Investors get excited about growth, and that excitement sometimes leads to valuations that, well, they're not really justified by current earnings.
Yeah.
They're essentially betting on the promise of future growth, even if the present reality doesn't quite add up.
It's like saying, we're willing to pay a premium now because we're so confident this company is going to be worth even more later.
Exactly. And sometimes that gamble pays off.
Right.
But other times, those high expectations, they can create a dangerous disconnect
Yeah.
between a company's stock price and its actual value.
So it's a good reminder to be cautious, to not get caught up in the hype, and to make sure those rosy growth projections, they're based on solid fundamentals.
For sure.
Always good advice, no matter what the economy is doing.
Couldn't agree more.
Well, that's about all the time we have for today's deep dive. It's given us, and hopefully you listening, a lot to think about when it comes to investing in a growing economy. Remember, it's not just about the fact of growth, but the nature of that growth and how it translates into value for investors like you. As always, thanks for joining us, and happy